Let me say this one more time, loud and clear. If you're shorting silver below $80 in the current global environment, you're not trading, you're not hedging, you're walking straight off a financial cliff with your eyes wide open. No parachute, no safety net, game over. Welcome back to the channel, folks. Today, we're not going over some basic candlestick patterns or the kind of watered down technical analysis that Wall Street loves to feed retail traders to keep them distracted. Today, we're talking about survival. We're talking about how to protect the wealth you've spent years building, and maybe even how to come out the other side of the storm in a completely different financial bracket. This is going to be a deep dive. It might run long, but I promise you, this is the most important analysis you're going to hear all year, because while most people are still dancing at the edge of the abyss, we're going to stare straight into it together. Using macroeconomics, geopolitical game theory, commodity supply and demand fundamentals, and the cold, hard mechanics of how modern markets actually work, I'm going to show you exactly why the US-Iran escalation, combined with the brutal reality of weekend market closures, is a death trap for anyone short silver right now. You ready? Let's get into it. What's actually happening in the Middle East? If your news diet is a 5-minute briefing from CNN or CNBC, you probably think the US-Iran situation is just another round of proxy skirmishes, a few missiles in the desert, some political posturing, the usual noise. You'd be dangerously wrong. What we're looking at right now is not friction. This is not a test. This is two nations with enormous geopolitical leverage sliding fast and seemingly irreversibly toward full-scale war. As of Saturday, March 14th, 2026, the US-Iran conflict has officially entered a state of open warfare. The operation, codenamed Deterrence, has evolved from precision airstrikes into what is shaping up to be a final showdown that could redraw the entire Middle East map and rewrite the rules of great power competition. The Trump administration confirmed on Friday, March 13th, that US forces successfully eliminated all military defense installations on Kharg Island, the island that handles 90% of Iran's crude oil exports. The export terminal is now functionally paralyzed, and the White House has made it crystal clear if Iran continues launching missiles at Israel and US bases, the civilian oil infrastructure on Kharg Island is next. The US has confirmed 15 killed in action. A KC-135 tanker went down in Iraq with 6 crew members aboard, a stark reminder of just how exposed US logistics are in this theater. Meanwhile, the USS Tripoli, an amphibious assault ship carrying 2,500 Marines and F-35B fighter jets, has left the Western Pacific, last spotted near Taiwan, and is now hauling at full speed toward the Persian Gulf. That ship's movement is telling you everything. They're preparing for either a special ground operation or a forced opening of the strait. Over in Tehran, Iran's assembly of experts formally selected Ali Khamenei's son, Mojtaba Khamenei, as the next supreme leader on March 8th. In his first public address, Mojtaba made one thing absolutely clear: Iran will use the Hormuz chokehold as leverage. The US has already put a $10 million bounty on his head, essentially telling the world they no longer recognize the legitimacy of the Iranian government. This conflict is morphing into a full-on regime change scenario. Iran has responded by unleashing hundreds of ballistic missiles and drones through its so-called axis of resistance at Tel Aviv and multiple US bases across the Gulf, including the Prince Sultan Air Base in Saudi Arabia. Here's the number that should make your jaw drop. In March so far, only 77 ships have passed through the Strait of Hormuz. In the same period last year, 1,029 ships. That's a 94% collapse in traffic. Maersk has declared force majeure and announced full rerouting. Qatar has halted LNG production entirely and also declared force majeure. That means next week, energy prices in Europe and Asia could go exponential overnight. 150, 200, even $250 oil, and what it does to silver. In a genuine supply disruption of this magnitude, crude oil doesn't inch up, it gaps. We could be looking at 150, 200, even $250 a barrel, not as some fringe prediction, but as a realistic outcome if Hormuz stays blocked. When oil doubles or triples, what happens? Global inflation goes absolutely feral. Everything that moves by truck, ship, or plane gets more expensive overnight. Everything made from petrochemicals, which is basically everything in the modern world, including fertilizer, sees costs spike exponentially. Every rate hike the Fed engineered over the past few years to wrestle inflation under control wiped out in days. And here's the brutal reality. The Fed is powerless against this kind of inflation. They can print unlimited dollars, but they cannot print a single barrel of oil, and they sure as hell cannot print a single ounce of silver. When fiat purchasing power starts getting torched in real time by war and hyperinflation, tens of trillions of dollars in safe haven capital, sovereign wealth funds, corporate treasuries, terrified retail money will go searching for hard assets at any price. Gold will get bid up aggressively, no question, but silver will move in ways that will make gold look boring. Let me explain why. And this brings us to the second critical mechanism I need you to understand. The weekend time bomb. Why short sellers are playing Russian roulette. Before we get into silver's fundamentals, I need to talk directly to every trader who's short silver right now, or thinking about it, because sometimes it's not the fundamentals that blow you up, it's the rules of the game. Modern financial markets have a deeply counterintuitive feature. They close on weekends. From Friday at 5 p.m. Eastern when New York shuts down to Sunday at 6 p.m. Eastern when Asian markets reopen, there is a roughly 48-hour window where global capital markets are completely frozen. Your trading platform shows a flat line. You cannot buy. You cannot sell. You are locked out. Now burn this into your memory. Markets take the weekend off. Wars don't. Look back through history. The overwhelming majority of world-changing military actions, surprise attacks, assassinations, declarations of war, happen over the weekend. Why? Because generals and politicians know exactly how fragile financial markets are. If you launch a strike on a Tuesday afternoon, the stock market craters immediately, panic spreads globally, and you're managing a financial crisis on top of a military one. But if you move on Saturday, you've bought yourself 48 hours to control the narrative, reposition your forces, and not have to face Wall Street's reaction until Monday morning. Now let's plug the US-Iran escalation directly into this framework. Picture this, you're a trader, it's Friday, silver is sitting around $80. You look at your charts, you see overbought signals everywhere, RSI through the roof, bearish divergence on every time frame. You think this thing is way overextended, easy short. So you load up on a leveraged silver short, pour yourself a drink, and head into the weekend feeling clever. Then Saturday morning, 2 a.m., US bases get hammered with saturation missile strikes. A major power announces it's entering the conflict. The war goes full scale. For the next 40 plus hours, you're sitting on your couch watching the news, explosions, fire, breaking headlines scrolling across every screen, oil prices expected to surge, Third World War on the brink. Every financial commentator on the planet is screaming about safe haven demand. You grab your phone, you open your brokerage app, you try to close your short position, and the screen is grey. Market closed. System message, trading unavailable. Can you feel that? That helplessness? You're chained to the railroad tracks and you can see the train, the War Inflation Express, coming at you at 200 miles per hour, and there is nothing you can do about it for the next 2 days. Sunday night finally arrives. Asian markets are about to open. You think you can get out on the opening print? Think again. In a panic of this magnitude, silver doesn't open a few cents higher and then grind up. It gaps. The moment markets open, a tsunami of buy orders floods in with nobody willing to sell. The price doesn't tick up from Friday's close, it teleports. Friday close, $80. Sunday open, $100, $130, maybe $150. If you're holding a leveraged short position, a $20 to $30 gap blows straight through your maintenance margin before you can even blink. At that point, your broker's computer takes over. To protect itself, the system buys silver at market price to cover your short, no matter what it costs. When thousands of short sellers all get force liquidated at the same moment, that buying creates another wave of upward pressure, which triggers more stop losses above, which creates more buying. This is the most feared term on Wall Street, a short squeeze, or as traders say, getting squeezed out. And here's the part that keeps people up at night. In an extreme gap up scenario, if the price moves so fast that your broker can't liquidate your position before your margin hits zero, you don't just lose everything in your account. You owe your broker money, your house, your car, your savings. All of it could be on the hook to cover the difference. That's why I say shorting silver going into this weekend is like loading a revolver with 6 bullets and pointing it at your own head. It's not a trade, it's financial suicide. Silver is not just a metal, it's the lifeblood of modern warfare. A lot of people have a fundamental misunderstanding about silver. They think it's just gold's little cousin, a second-rate safe haven asset, jewelry and coins. That's it. If that's what you think, you have no idea how modern technology or modern warfare actually works. Silver is the most electrically conductive, thermally conductive, and reflective metal on Earth. It's not just a monetary asset, it is the critical industrial blood of high-tech civilization and the military-industrial complex. When we talk about full-scale war between the US and Iran, we're not talking about World War II infantry tactics. We're talking about the most technologically sophisticated military engagement in human history. Do you know how much silver is inside a single Tomahawk cruise missile or a Patriot interceptor? How much high-purity silver solder and silver coating goes into an F-35's radar system, infrared targeting array, and electronic warfare suite? Every military drone blanketing the modern battlefield, every satellite navigation system, every supercomputer inside a command center, their critical electronic contact points literally cannot function without silver. In peacetime, industrial silver demand is already driven hard by solar panels, electric vehicles, and consumer electronics, keeping the market in a structural supply deficit. But here's the key distinction. Peacetime industrial demand is price sensitive. When silver gets expensive, manufacturers look for substitutes or slow down production. War economies don't care about price. When a nation goes into full wartime mobilization, the defense industrial complex runs at 100% and then some. Governments invoke emergency production acts. Defense contractors don't debate whether silver is $50, $80, or $200 an ounce. They need to build missiles, radar systems, and aircraft, and they will sweep every last ounce of physical silver off the global market at whatever the price happens to be. When national survival is on the line, the price tag is irrelevant. On top of that, central banks and governments globally will recognize the strategic importance of silver stockpiles, not just the US. Every nation that feels the heat of war will start quietly or openly hoarding silver. It will be officially classified as a critical national security metal, right alongside rare earth elements and uranium. What you get is a terrifying supply-demand scissors effect. On one side, an insatiable price-inelastic demand from the war machine. On the other side, and this is what I really want you to understand, a supply side that is about to completely collapse. The supply side is broken and it can't be fixed quickly. If you're going to short silver, your entire thesis depends on the belief that the market will be flooded with new supply to cap the price. Let me show you why that's a fantasy. Here's something most people don't know. The vast majority of the world's silver is not mined from dedicated silver mines. It's a byproduct extracted as a secondary material when mining copper, zinc, and lead. Byproduct silver accounts for over 70% of global annual silver production. Think about what that really means. When the global economy tanks from geopolitical conflict, high oil prices, and raging inflation, demand for copper, zinc, and lead, your construction and industrial metals, craters. Mining companies start shutting down unprofitable base metal mines to cut costs. When those mines go offline, silver production drops off a cliff with them, regardless of how high the silver price is. You literally cannot incentivize more silver supply just by raising the price, because the supply isn't driven by silver economics. It's driven by base metal economics. Economists call this inelastic supply. In plain English, you can't just turn on the tap. Now look at where most of the world's silver comes from: Mexico, Peru, Chile. politically unstable Latin American countries where labor unrest is already simmering. When war-driven global inflation spikes their cost of living, you're going to see mining strikes, resource nationalism, export tariffs, and potentially outright nationalization. Add to that the fact that insuring and physically shipping heavy silver bullion from South America to North America or Europe becomes insanely expensive and dangerous when global shipping lanes are disrupted by conflict. Stack it all up. Byproduct production that can't respond to price signals, geopolitical instability in producing countries, and a fractured global supply chain. You're looking at a historic silver supply drought right at the moment when demand from both the war machine and panicked investors is going exponential. And to whoever is sitting there thinking about putting on a short position at $80, who exactly do you think is going to sell you all that silver to close your position later? The dirty secret: paper silver is a ticking time bomb. Now we get to the darkest and most explosive part of this whole story, the massive fraud sitting at the core of the silver market and why it could trigger the most violent price explosion in financial history. If you've been following precious metals for any length of time, you know about COMEX, the New York Commodities Exchange, and the LBMA, London Bullion Market Association. For decades, Wall Street's big bullion banks, the so-called market makers, have been running an extraordinarily dangerous leverage game. Through the futures market, these banks have created enormous quantities of paper silver contracts that have zero physical backing. When you buy a silver ETF or a silver futures contract, you are, most of the time, not owning actual silver. You're entering a bet with a bank, a bet settled in dollars. Conservative estimates suggest the ratio of paper silver contracts trading on COMEX to the actual registered physical silver available for delivery in COMEX vaults is somewhere in the hundreds to one. What does that mean in practice? If 100 people all showed up demanding physical delivery at the same time, the vault only has enough for one of them. At its core, this is a fractional reserve Ponzi scheme. In calm times, everyone plays the digital numbers game. Almost nobody actually shows up with a truck to haul away silver bars, so the scheme perpetuates itself indefinitely. The bullion banks use their massive capital advantage to dump tens of thousands of paper short contracts at key technical levels, engineer flash crashes, and shake out retail longs. It's been the playbook for 40 years. But here's what changes everything. The moment the US and Iran go to full-scale war, the moment fiat purchasing power starts visibly melting away in real time, the rules of the game change permanently. The real money, the ultra-high net worth individuals, the sovereign wealth funds, the multinational corporations, they're not stupid. When they realize fiat currency is turning into wallpaper, when they realize war could cut off global communications and banking systems at any moment, they stop trusting the numbers on a screen. They do something simple but devastating. They demand physical delivery. When the big players start abandoning paper gold and paper silver and insisting on getting actual metal bars delivered to their private vaults, COMEX physical inventory gets drained in real time. We've already been watching COMEX registered silver inventories trend downward for years. A full-scale great power war is the final straw. And if one day, whether it's COMEX or the LBMA, there's a major physical default event, or if the exchange shamelessly declares force majeure and tries to force cash settlement instead of delivering actual metal to clients who ask for it, that moment will be a financial nuclear detonation. Every investor on Earth wakes up simultaneously to the same realization: paper silver is worthless. Physical silver is the only thing that matters. And at that point, the pricing power shifts permanently from Wall Street futures traders to whoever is actually holding physical metal bars. This is why shorting below $80 is suicide, because what you're shorting is the paper silver system, and that system is on the verge of implosion. When the physical short squeeze hits, short sellers have to go buy physical silver to close out, except there is no physical silver available. The price doesn't respect any technical resistance level, it goes vertical. $100, $200, those aren't ceilings, they're waypoints. Why $80 is not the top. It might just be the beginning. People always ask, what makes you so confident $80 is still cheap? Fair question. Let me give you a quick macroeconomic history lesson. Silver has hit the $50 level twice in modern history. The first time was 1980, when the Hunt brothers tried to corner the silver market against a backdrop of the Iran-Iraq war and raging inflation. The second time was 2011, during the Fed's QE blitz, when the world panicked about dollar debasement. Two dates, 1980 and 2011. It's now 2026. Here's the concept you need to understand. Inflation adjusted price. What could $50 buy you in 1980? A hell of a lot more than $50 buys today. If we use the US government's own official CPI to inflation adjust 1980's $50 silver, we get a figure that blows well past $150 in today's money. And if you know that CPI is a manipulated, understated number through hedonic adjustments, substitution effects, and other methodological sleight of hand, and you use something closer to actual 1980 style inflation measurement like what ShadowStat publishes, that $50 in 1980 represents thousands of dollars in real purchasing power today. Now let's look at the gold to silver ratio. Silver is roughly 16 times more abundant than gold in the Earth's crust. Throughout thousands of years of monetary history, the ratio averaged around 15.1. Today, it's sitting at historically elevated levels. If gold, driven by war panic and inflation expectations, marches toward $5,100 or even $6,000 an ounce, and the gold-silver ratio simply reverts to its modern historical average of 50.1, silver should be at $100 or more. If the ratio compresses to 30.1, which it hit in 2011, against a $6,000 gold backdrop, silver is pushing $200. And once silver breaks $50 in this environment, fueled by a full US-Iran military conflict, the algo traders, CTA trend-following funds, and retail FOMO all pile on simultaneously. In days, maybe hours, that momentum can push the price to $150 or $200 with breathtaking speed. If you're sitting at $80 thinking this has gone too far, it's got to pull back, and you short it, you are literally stepping in front of a nuclear-powered freight train. You will be vaporized. The math of asymmetric risk and why this trade is insane. Every serious investor, every trader who's actually managed to survive long term in these markets, they all know the first question before entering any trade is never how much can I make? It's always how much can I lose? The holy grail of investing is asymmetric return profiles, limited downside, unlimited upside. Buy $10 worth of a great company with no debt. Worst case, you lose $10. Best case, you ride it to the moon. Shorting silver right now is the exact mirror image of that. The worst possible asymmetric trade you could make. Let's run the numbers. You short silver at $80. Your absolute best case scenario, the US and Iran magically kiss and make up. The Fed declares victory over inflation. Silver crashes back to $50. You pocket a $30 gain. That's your maximum profit. Capped, done. Your downside, theoretically infinite. If war breaks out over the weekend, oil spikes to $200, global physical silver demand goes berserk, and COMEX announces forced cash settlement, silver could open Monday at $100, $150, $300. With leverage, you don't just lose your account. If the gap moves faster than your broker can liquidate you, you legally owe the difference. We're talking your house, your car, your entire life savings, all of it going to cover the gap. You're risking financial ruin, losing everything you have to capture a capped limited profit. That's a mathematically negative expected value trade. That's not investing. That's not even gambling. That is a death wish dressed up in a trading terminal. Shorting makes sense in stable macro environments where you're fading irrational exuberance in specific assets. But at a historic inflection point, where the old world order is fracturing, great power war is breaking out, and the fiat currency system is wobbling, shorting any scarce hard asset is fighting the tide of history itself. You're not trading against a few retail bulls. You're trading against the entire US defense industrial complex. You're trading against trillions of dollars of global wealth desperately searching for a safe harbor. You're trading against thousands of years of human civilization recognizing precious metals as real money. And you're trading against the most powerful macro forces on Earth. Final thoughts. Let me leave you with something personal before we wrap up. We are living through a moment that history books will come back to for decades. When we're old, our grandchildren might ask us, when the great powers started moving toward war in the mid 2020s, when global inflation ran out of control, what were you doing? I don't want your answer to be, I was shorting silver for a few bucks of profit and I went bankrupt. The past 40 years trained us to expect peace, low inflation, and an environment where you could just buy stocks and bonds and watch them go up. That era is over. The current global geopolitical landscape is a warehouse stuffed floor to ceiling with gunpowder, and the US and Iran are in there playing with matches. In this extreme macro environment, silver isn't just an investment, it's a financial Noah's Ark. It carries both the safe haven properties of gold and the strategic industrial properties of oil. It's a coiled spring that's been suppressed by paper derivatives for 4 decades, and the hand holding that spring down, the hand of peace and macro stability, is being cut off by the sword of war. $80 is not the ceiling. It might not even be the halfway point. It's a fragile threshold. Once it's behind us, we're in completely uncharted territory with no technical ceiling in sight. If you already hold physical silver, hold it tight, lock it in a safe. Don't let the day-to-day noise shake you out. When the storm hits, the metal in your hands is real wealth. If you're long silver with paper positions, watch your leverage. Before the mother of all short squeezes arrives, the bullion banks will make one last desperate attempt to shake out weak hands with violent two-way swings. Stay patient, stay clear-headed. And if you're still holding short positions, or if you're still thinking, I'll just wait for the dip, I've said everything I can say. The market doesn't do sympathy. It doesn't reward ignorance. When you choose to swim against the current at a crossroads like this, you accept the consequences of being swallowed by the wave. Remember that 48-hour weekend blackout window is counting down right now. The US-Iran situation can escalate at any moment. Never pick up pennies in front of a speeding nuclear freight train, especially when the penny might end up costing you everything. Read the room, let go of the fantasy, get on the right side of history. This is deep macro. If today's analysis showed you what the mainstream financial media won't touch, if you think this information could protect you and your family's financial future, smash the like button, hit subscribe, and please share this video with anyone you know who's still navigating these markets blind. One share from you could change someone's financial life. Stay sharp out there, protect your hard assets. See you in the next one.